it's always good to get a big money manager to try and figure out what is it that their train of thought is currently as the coronavirus cases are rising. India seems to be entering into another period of probable more stringent lockdowns, which are more widespread. And having said that, it's not just COVID which will determine what the investment strategy would be. There will be things beyond COVID as well. Are themes of the bigger companies becoming even bigger here to stay? And is that playing out as well? Are there alternates to China which are emerging? Would the traditional investment valuation parameters hold true? Well, let's get in a large money bag to talk about what is it that he thinks he would do in the current scenario. Mahesh Patil of Aditya Birla Sun Life needs no introduction, really. Joins in right now with his thoughts. One of the largest AMCs in the country. Mahesh, so good having you. Thanks much for taking the time out. Um,
Yeah, good morning, Niraj.
Good morning, Mahesh. Mahesh,
Yes.
what's the current thought process when you look at investing? Because we are no longer at 7,500 when valuations were mouth-watering, when almost every valuation parameter showed that things were looking cheap. And at these levels, maybe valuations might be a bit right, but we are also entering into a period of heightened uncertainty because we'll have a earning season which will be full of bad news, and we are seeing coronavirus cases still rising.
Yeah, so I think, you're right. I mean, the crisis is no doubt really large, and the impact of the crisis on the economy is really big. I mean, that reflects in the GDP number estimates, okay, which are there for global and for India. And we've seen the markets after the correction has rebounded almost 40% from the lows, which is pretty fast and quick, and happened contrary to a lot of people expectations. And so I think obviously the question is now what from these levels, right? One thing to understand is that this time around the response of the central banks and the governments globally has been unprecedented and very swift. I mean, learning from the global financial crisis, they've been quick to respond, and the quantum of stimulus also which has been given is almost double than what we saw during the global financial crisis. And as a result of that, there is increasing belief that while the next quarters, okay, this quarter, first quarter and second quarter will be weak, but we should see a recovery coming in back fast. And virtually a V-shaped recovery is what the market is expecting. And that's what I think market started to build in and factoring and then overlooking the near term, this CY21 or FY21 is virtually going to be down. So look beyond that, and that's what one started to look in, and we see the market reflate back. So as we stand at this juncture, right, with Nifty at around 10,800 odd levels or so, if we break it up into two parts, right, the near term and the long term. So, from a near term perspective, yeah, the markets have retreated pretty fast, and there is still some amount of uncertainty, as you rightly said. The new virus cases in India, at least, are still not peaked out, and you might see things deteriorating further over there. But clearly, I think the government and policymakers have realized that there's no need for a extended lockdown, okay, which is required. Okay, need to contain in specific areas, and there is some hope coming in because of recovery, some new drugs coming into the market. So all these things are leading to a belief that you should see the recovery and normalcy coming back much sooner. But the fact is that near term, there could be some kind of challenges globally also. Earnings will be bad, and one can expect some correction in the near term. I think one should be prepared for that. A lot of retail money has come into the market, which can be a bit tricky. Okay, that can lead to volatility in the near term. So from a near term perspective, when I say near term, next 3 months perspective or so, the risk reward in the market is well balanced. I think there could be some downside also from here. Upside could be limited. But if I take a longer term view, and that's what I think a lot of fund managers are doing at this point in time, if I take a 3-year view and then look at arguably on the earnings front, if you look at it, the market will look very expensive because earnings have been decimated. And it's not now, right? It's in the last 5 years, if you look at earnings trajectory has been well below the long-term average, right? It's been around 4.5% if you look at FY 15 to 20, and there were various factors. So even coming into the crisis, we've seen the earnings were fairly depressed. And I think if you assume that if you forget this year, FY 20 and 21, And if you assume that things will normalize in the next 2 years, FY23, right? And even if you take FY19 as a base and assume that 9% is the CAGR in earnings, which is still lower than the long-term average of 11%, then and if you look at the earnings in FY23, then the market was reasonable upside from here, okay, which could be probably higher than the long-term average, because if you look at it, if you assume that the P multiple normalizes over that time frame, I think we're looking at around 14 to 15% kind of returns for the market. Even the price to book value multiple is a good indicator at this point in time when earnings are depressed. So that suggests even now at current levels, the price to book value multiple long-term average is around 2.93. We are currently at around 2.6. So it's around 10% lower. And as that normalizes over the next 2 years and the increase in book value, I think the returns from market from a long-term perspective would also be somewhere in the mid-teens is what we are looking at.
Can I cross question you, Mahesh, a bit on
Yes.
that? And which is the valuation multiples that we quite so often look at, right? The historical versus the current, price to book, price earning, or even market cap to GDP. How much of importance do you give to those in the current context? Because the denominator, whether it's the earnings or the book or the GDP number itself, is just so uncertain currently.
Yeah, so I think in these times, see, one is one can take some benefit of the trailing earnings. So if you look at earnings, it's better to look at the trailing P multiple than the forward earnings multiple, because earnings are going to be very uncertain in this fiscal year. But other parameters like price to book value, which because just because the impact of the virus, okay, there's going to be a one-year impact on earnings, that doesn't change the overall value of the firm, right? Just 1 year earnings getting knocked out doesn't change the long-term value of a firm. And price to book value is a good indicator at that point in time. Book value is a good indicator to get a sense what is the normalized value of a company. So in during these times, I think we find price to book value or market cap to GDP also, because in the longer term, we see that the company's or value is linked to the GDP, right? Even the market cap overall goes in the longer term in sync with the nominal GDP growth. At times, there could be distortion and variation because of some internal and external factors, and that's what we are seeing at this point in time. But that normalization happens over a period of time. So these two parameters, price to book value and market cap to GDP, during these uncertain times, give us a good kind of a barometer to really see how the market is valued relative to its long-term valuation. And on both these parameters, we see the market being attractive even at these current levels.
Okay. So in your investment hypothesis, Mahesh, correct me if I'm wrong, where money is coming into the mutual fund, you are essentially investing it into businesses which you reckon could do well over a 2-year period after discounting FY21 completely. Would that be a fair assessment in some part of your portfolio, if not all?
Sure. No, I think increasingly, especially companies and businesses which are getting disrupted severely in FY21, we are looking at FY22, okay, some, but even FY23 numbers, right? To see that, 23 is a base case where we think that 3 years down the line, we'll back to normal, a normal trajectory of growth, intrinsic growth, what the economy has, I think will be that level. And that's the level where we try to project and then discount that and see, okay, where what's the value or upside there in individual names. So I think, every crisis we see that if you are able to look beyond that, and obviously it's a bit tricky because of the crisis, each company or sector will get impacted differently, right? There are some companies which could probably benefit out of this, and they could see a further acceleration. Other companies or businesses could get disrupted. So one needs to take that into factor. But overall, on the macro level, clearly we would look at FY23 numbers and try to base our valuations and the estimates target price based on those numbers, and then discounting that 2 years ahead.
Okay. Just one quick question before we move on to the other. The whole basis of your investment decisions. And one question or one follow-up that I have there is, are there businesses which are disrupted for FY21 but could recover in 22 or 23 available at mouth-watering valuations? Because I'm just guessing that otherwise why would anybody want to put in the money there unless the valuation is that big comfort point currently? I mean, now that the market has rallied and is no longer at 7,500.
Yeah. So again, there are different kinds. There are some businesses, okay, which are likely to recover much faster. There are others like because of social distancing, and we all know that the impact of the virus will be around, and even if we find a cure to that, it will be some time away, whether it's a vaccine or anything else. So, businesses in the hospitality sector, for example, the aviation sector, multiplexes, all these are going to see an extended period of earnings getting impacted and things coming back to normalcy. These kind of businesses are clearly at much depressed level. They haven't really rebounded much if they get back because the recovery there is going to be slightly more back-ended. But yeah, I think the companies which survive in these businesses, okay, will clearly have we could see a big upside a couple of years down the line, and there the valuations are still attractive, I would say. But apart from that, I think there are other sectors, especially in the consumer discretionary side, okay, where again, there also the impact is going to be fairly severe. But good businesses over there are good quality companies, have corrected, say, around 20% from their earlier pre-COVID levels. So we see good value again in the consumer discretionary side, whether it is autos. Autos to some extent have rotated back, especially the two-wheelers. But other consumer durable, the retailers, retail also sector is going to see a big impact because people are not able to go and visit malls. But again, the larger companies over there are likely to consolidate further and gain market share, and things normalize. One can see upside over there. So these are some of the sectors, and obviously the cyclical sectors, other cyclical sectors which are still depressed, the capex and other related sectors. I think that will take some more longer time to come back because capital investments we think will be further delayed down the line. But okay, the sectors would provide more opportunity, more time for somebody to get into that space. So, but I think overall, I think the overall market itself, if I look at it, even at these levels, as I mentioned earlier, is below its intrinsic value, is what we look at it, right? When I say that the price to book value multiple is a good indication of that, that's showing that it is around 10% lower. So while it has reflated back, broader market itself is below the intrinsic value at this point in time, if I take a 3-year view.
Got it. Okay. So Mahesh, you give me a segue into my next line of questions, and that is this whole theme of the larger and the stronger companies consolidating and increasing their market share, the big becoming bigger argument, which has been there now for a while. And I presume that most people believe that COVID-19 will only accelerate that. Would you reckon that is true? How longer can this theme continue, and how can investors play it? How are you playing?
So I think the big becoming bigger to some extent started off with the demonetization in GST, right, where we saw the large organized players gaining a market share because there was more transparency in terms of tax payment, and the supply chain also got consolidated. And we saw that first round, right? So if you look at the market share, for example, of the top 5 companies across sectors, we did some analysis. So pre-GST, it was around 59%. The top 5 companies' market share. That increased to around 62% currently. And we think that will go up further, okay, post this COVID crisis, because in this crisis, we've seen that larger companies which have got stronger balance sheet, larger cash reserves are able to tide over the situation much better. They're able to invest back into the business, gain market share. And clearly, this is a time where some of the smaller companies are facing challenges in terms of liquidity. That the government has tried to infuse liquidity, but it's not really flowing down. And I think other big change driving is that bigger companies are able to make the change. Adoption of digital. Okay, that's again a big shift or long-term trend which we are seeing, are able to do that much better, and as a result, gain market share. So I think we are seeing these trends across various sectors. We've been seeing that in the banking sector, it has been going on for quite some time. The large private banks have been taking market share. And I think now in this current environment, the larger banks, especially on the liability side, okay, which are strong, will be able to again consolidate their market share on the liability side and also on the asset side and gain further. In the financial services sector, I think we'll see that happening in a much, much bigger way, right? In the last decade or so, we've seen a mushrooming of NBFCs. Now, especially after the the crisis in the NBFC sector, which erupted a couple of years back, and now after the COVID crisis, I think you will see a lot of smaller NBFCs either shutting down or getting consolidated, and you will see only a handful of NBFCs really surviving. So that's clearly a trend emerging in the financial services sector. And obviously, in other sectors, like for example, consumer durables, we are seeing the larger players gaining market share from the unorganized sector. We've seen that happen in a big way in the retail sector. Like for example, in the jewelry space, for example, the larger organized players are gaining market share from the unorganized sectors, which are getting impacted, especially in this crisis. There is a severe liquidity problem, okay, which some of these retailers are facing, and the large organized players are able to expand their footprint much longer and also gain market share in the existing area as well. So these are the sectors where we see the big becoming bigger, getting more accentuated and faster. But I think it is happening across the sectors, and companies which are able to adapt more nimble, got good management and able to capture those opportunities, I think will come out winners in this space. And even while as the overall economic growth will take no time to recover, and we see it slightly lower, the growth in some of these companies could be higher than the overall industry growth for this.
Got it. Viewers, there's an interesting couple of data points as well, which came out of this as well, or we were just trying to prepare for this interaction. And the becoming bigger in the second wave of consolidation, pre-GST or demon, the top 5 companies' market share in a number of spaces might have been about 59%, and went up to 62%, and likely to expand further as well. And financials, something that Mahesh mentioned, the top 6 private financials market cap as a percentage of overall financials actually touched a high of 55% as well, and that's quite staggering. It's just one quick follow-up to that, and that is on financials. Now, you are right, and I think everybody will concur that the dominating larger balance sheets and the market, is stronger names will gain share. But there is also this lurking danger over the next 6 to 9 odd months of asset quality issues coming up. Now, 3 years out, that is a no-brainer. My question is, how do you think the market will behave over the next 6 months as NPAs, moratoriums, etc., all affect the sentiment and the books of these large quality financials as well? What will happen to them then in their ensuing 6-month period?
Yeah, I think that's a great question, because if you look at the market fall also, okay, what we see, large extent led by the financials. The financials had become a pretty dominant part of the market. In the last decade, you've seen the weight of financials in the benchmark has increased significantly. It's peaked at around 42, 43% of Nifty, which has now come down to around 34, 35%. So clearly the financial services sector has got big impacted, and rightly so, because of concerns about NPA. More this time around on the retail NPA, right? You've seen the corporate NPA cycle play out for the last 3 years or so. And yeah, there is going to be an impact because a lot of job losses, income levels coming down. We see increased level of NPAs. Our estimate is that you could see around 2% to 3% increase in the NPA levels at the aggregate level, which is pretty meaningful. And that will impact the bank balance sheets. We've seen a moratorium which has been given, so you won't see that in the numbers until the December quarter. It will start only coming in after that. But so I think in this environment, I think the banking sector and the financial services sector will remain a bit depressed, and it is probably lagging recovery. But I think the way I see it is that, again, within that sector also, I think banks which are, the bigger banks and which have got a strong liability franchise and have been able to, good management and able to manage the asset quality reasonably well, they will be able to see, because bank needs to now shore up their capital, right? To take care of the provisions which they have to make for the higher NPAs, but also for growth capital. So only a few banks will be able to actually do that and tap the capital market and raise capital. And we've seen the larger banks do it, and one or two banks have done that, like Kotak did that. Other banks are also starting to do that. So I think banks will be able to shore up their capital base, have access to the capital markets, and do that at a reasonable valuation, right? Because if you do that below book value, you will be actually destroying value over there. So those banks will be able to consolidate. They can make the provisions, okay, whatever needed for this year. In fact, a lot of banks are making accelerated provisions, okay, for the COVID crisis. We saw that in the last quarter also, and this quarter you'll see that doing that. So then I think they will be able to come out whatever hit needs to be taken and have the balance sheet in shape to take care of the next leg of growth, okay, which will come back, say, in FY22 and 23 going forward. So, I would say overall banking sector might remain a bit subdued at this point in time, but 3 months down the line, I think the sector, again, I think if India economy has to recover, the banking sector has to be in good shape, and for the market to again come back, this sector has to come back. I think we think that the larger banks there are in better shape. They should be able to manage this crisis better. They are raising capital, and after making the necessary provisions for the NPAs, they should be again have the balance sheet to again go out and lend and contribute towards the overall credit growth. So I think if I take a longer term view, I think banking sector after next 3 to 6 months, okay, would be a good time to start looking at the sector and building exposure over there. Is what we would be looking at. Currently, we are neutralish on the sector. The valuations are looking very attractive. A lot of the banks are now at valuations which are attractive compared to the long-term averages. There's the slight concern on the NPAs, which will keep them probably depressed for near-term perspective.
So a bit of a tactical view out there as well from Mahesh Patil. Mahesh, the other question is this whole theme of alternates to China. Now, in your assessment, when you speak to companies, when you speak to global investors, your global counterparts, etc., how real and present would this be for a country like India? And would themes such as import substitution, back-end manufacturing, API/slash specialty chemicals, etc., or even exporters who might get a foothold into countries where they might want to, kind of segregate supply chains, what have you. How real and current is this theme? And is it attractive enough from an equity investing perspective?
Yeah, so I think this is something which we've been talking about for many years, and we wanted, but somehow we didn't get traction over there, right? India was not able to really get a large part of the global supply chain. But what has happened in the recent past, especially after the COVID crisis, we've seen that a lot of global firms have seen that there are large dependence on China, okay, for outsourcing. They've seen some disruptions around this time, and there was no alternative. And they're seriously looking at alternative geographies where they could source in. Obviously, that some of that, even earlier in US, because of the trade tensions, we've seen that happen. But that has only accelerated now. It's not only US, but a lot of other countries also. Europe is looking at alternative to China. And in that context, I think India was lagging behind. We saw initial phase that manufacturing went into other Asian countries, right? But I think over a period of time, we've seen that India has done a lot of work on the infrastructure side. I think the infrastructure deficit has addressed to a large extent. We've seen the road, the rail infrastructure also coming back in shape over there. There are softer issues like labor and land reforms, okay, power, for example, which needs to be addressed. And I think every crisis, I think, comes an opportunity. I think in this crisis, I think India is looking to see this as an opportunity if we really want to come back in terms of overall growth. And if we're able to get the manufacturing sector kicking in, I think we can compensate for that for lack of investments on the infrastructure side. And the government Prime Minister also said that they will look at labor and land reforms. Some of the states have already taken initiative over there on the labor reforms, like, for example, UP and Rajasthan. They have amended the old archaic labor laws. So I think if work happens on that, I think we could see large-scale global companies coming in and setting up manufacturing base over here. I mean, you should not underestimate India, because India is also a large domestic market, right? Which gives you the necessary scale and size, okay, which is important for some of these companies if they really want to compete with China, scale and size to get the low cost of manufacturing. So India has that domestic market, and I think recently, I think the tax cuts or taxes in India were also on the higher side. So we've seen the tax cuts which have happened on the corporate side that has also narrowed the gap vis-a-vis the other countries. The new tax rate, which is around 15% for new manufacturing, is fairly competitive now with other countries in the region. So all these enablers which are in place, and I think the urgency coming in from the government, I think its time is right for India to really take a lead, especially in a few sectors, like for example, in the pharmaceutical API, in electronics area where we are importing a lot of stuff from China. I think there is increasing resilience, and even India has also realized that again, what has happened recently with India and China. India has realized that our also dependence on China for imports for certain categories, we need to reduce that. And there is, I think you will see a lot of policy measures and incentives given for companies to really start manufacturing in India because of that reason also. There's also going to be import substitution for India, okay, which will drive manufacturing. And we see sectors like pharma, electronics, specialty, chemicals, textiles are some of the areas, okay, where India can take a lead in this Make in India opportunity.
Okay, interesting. And something, Mahesh, that is probably leading some bit of this is also the opportunities that digitization throws up, isn't it? What are your views here? Because that's again a very wide bucket, you would have to say. And when I looked at some of the things that are coming up, I mean, work from home, consumer preferences, changes there, technology adoption in industry, you, me, and everybody who are talking right now as well and doing those meetings, all due to this, right? So,
right.
What does this open up in terms of possibilities, and where are there investable opportunities? Because a lot of people also kind of lament the fact that some of these are available in the private space and not so much in the publicly listed space.
Yes, I think digital and digitization is going to be all pervasive across sectors, right? So there'll be some direct beneficiaries of that, but we see that impacting across businesses in some way or the other, and companies which are able to take advantage of that will get that extra edge, okay, for them to leapfrog ahead compared to the others. So, as I said, work from home is going to be a reality after this, and many companies have now realized that, and then seeing a lot of, even after this crisis, you will see a large part of the workforce working from home. Okay, this is a way in terms of improving productivity and reducing cost, but clearly that means that you will require much more data. Okay, the requirement of data and bandwidth will increase. So companies which are present in that segment, so we'll see a lot of hardware companies in that segment starting to benefit. In fact, current lockdown, we see demand for hardware has been in short supply, right? So a lot of companies in which are supplying hardware, computer hardware, we see the demand for that will increase significantly. But apart from that, I think clearly the fintech sector, we're seeing payments, okay, especially in this crisis, going digitally. So a lot of fintech companies will emerge. And in India, what has happened is that because of the rapid increase in penetration of mobile broadband, right, we've seen an unleash of that wave in the last 3 years with Reliance Jio coming in, and data being available very cheap. I think while home broadband would take time, but mobile broadband is now all pervasive. I think the penetration levels that have increased to around 60% or so. So digital payments, e-commerce, and all those things will, I think, adoption over there will only accelerate. And companies which are able to, so on the front end side, many companies have actually moved towards that platform and enabled that to make it easier for consumers to come in and buy their goods and services digitally. And companies which have made it seamlessly and with a good interface will see benefiting out of this. But also, it's not only the front end, okay, digital, but also the back end, how technology and digital is being used, is also providing a differentiation for many companies. be it in their on the production side or how they are adopting on the supply chain, okay, digital to gain advantage. I think that is going to something which is not apparent to the external world, but when we talk to companies, they're seeing a significant advantage on the cost side, okay, as they use the technology. So improving productivity, less labor. So all these things are we see that pervasive across companies, and companies which are able to take a lead on that, I think will emerge winners in each and every sector and each and every category is what we see.
Well, let's wait and watch how this shapes up. But that's a lot of food for thought, Mahesh, from for an investor's perspective as to how to go about doing those investments. And I thank you for joining us on Talking Point today and trying and talk about some of those. And wish you happy investing and hope that all of you stay safe.
Yeah, I think it was a pleasure interacting, and I think we all hope that we'll come out of this crisis sooner. I think things are looking optimistic, and let's keep our finger crossed. Yeah,
Yeah, for sure. Mahesh, thank you so much for joining in today.
thank you.
And viewers, thanks for tuning into this edition of the Talking Point.